The following podcast by Fusion Family Wealth, LLC, Fusion, is intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Please see additional important disclosure at the end of this podcast. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.
Welcome to the Crazy Wealthy Podcast with your host, Jonathan Blau. Whether you're just starting out or are an experienced investor, join Jonathan as he seeks to illuminate and demystify the complexities of making consistently rational financial decisions under conditions of uncertainty. He'll chat with professionals from the advice world, entrepreneurs, executives, and more to share fresh perspectives on making sound decisions that maximize your wealth. And now, here's your host.
Welcome, everybody, to another episode of the Crazy Wealthy Podcast. I'm so happy today to have a friend of many years, Scott Ditman. We met actually today. I'm 58, and I'm not going to tell you how old Scott is. You'll figure it out when I tell you the next line. But I'm 58, and Scott and I met in about 1997. So I was about 31, and Scott was about 40. And the years go by quickly. But what a wonderful friendship, professional relationship, and everything else. So I want to welcome Scott Ditman, who is a consultant and former head of the tax estate planning group at Berdon LLP, which is now part of Citrin Cooperman. So Scott, welcome to the Crazy Wealthy Podcast.
Thanks, Jonathan. It's great to be here.
Yes, I feel the same way. It's great for you to be here. No, I'm just teasing you. So I thought we'd start off today. I know something you and I talk about a lot as we developed our professional relationship many years ago. We really appreciated the perspective that each of us brought to the table as it related to working with synergy as it relates to all of the different disciplines, from estate planning to investment planning to tax and cash flow planning and insurance planning, and all of those disciplines, and to recognize how important it was to make sure that we had a great team, that we all can't do everything. We're not the Rambo of investments or tax or financial planning. We need disciplinary approaches and to coordinate them together. So why don't we talk about that? I know you have a very definitive perspective on the importance of that. I'll let you talk to it.
Yeah, it's a funny thing to me as I evolved in working in this personal wealth services area, as we call it. I noticed that one of the biggest flaws in helping our clients is each of us, whether an accountant, an attorney, an investment advisor, an insurance specialist, we each work in our lane and we take care of what we're supposed to do. But I noticed a lot of professionals just did their work in their lane and didn't focus on the big picture. I'm doing my job, but in context, what I'm doing, how does it fit in to taking care of a client's holistic plan? And I've seen that throughout the years, that's something that's really not done nearly enough or thought about enough.
And when as you learned that experientially by seeing that it wasn't being done enough, what did you do, or what were you able to do to address it, right? Because you can control your approach to that, but you can't always control, particularly if you or I didn't coordinate or bring in the other professionals in each of the disciplines, estate planning. So how did you address that politically in a politically correct way to make sure that, hey, let's get back on the same page?
Well, and I'll give you an example, like in our space, like when you and I work together. Like I would say to a client, I think I could be helpful in context, helping you if I sit in on the quarterly investment advisory meetings. Like, for example, right before this podcast, I was in a meeting. It was an hour and a half with a client. The client has real estate business. The client has a lot of personal inherited wealth. And trust me, I'm not going to this meeting because I'm giving suggestions on asset allocation and picking stocks and bonds. I'm in there to provide context. I'm listening and we're trying to help. We prepare the tax returns for the individuals and the entities. So as an accountant, you have a unique perspective on what's going on because you're involved in the day-to-day. You see all the drill down information because you do the tax returns, you do cash flow modeling, you do financial statements for the businesses. So you're in a unique spot. So I sit there in a lot of these meetings and I listen. And then if someone says, we're looking to make transfers for estate planning purposes, what should we think about transferring? Because we work with the real estate on a day-to-day basis, we have a very good handle on what assets are potentially going to grow, what assets produce cash flow. So you can really help in this context. When there's a lot of trust, you know where to take distributions from, where not to. So you sit there and you listen, and in a very, like you said, politically correct way, you're just there to help. And you try to widen the conversation. So the investment advisor is not just talking about, increasing wealth and how we did in the quarter. We're looking at the strategic plan and how each of us is helping to take care of that. And by the way, in this meeting, the estate planning attorney was on the call. So it was done in a very, very positive way. So when the other advisors really don't think this way, in a very nice way, you just try to encourage them. You talk to the client. And then I find that by being involved in these meetings, say on a quarterly basis, the client sees and appreciates how 1 + 1 = 64, instead of each of us just doing our little thing. And then the client's overall goals may or may not be taken care of.
And so basically part of what you do is you try to, where possible, insert yourself into one or other of the planning meetings. And this way, as an observer who has the benefit of the broad tax based knowledge that comes off of tax work, tax returns. And I appreciate that. As you know, for the audience, I have a master's of tax in tax and a master of business in accounting. So my first 5 years was spent in tax. And I always knew I wanted to come into the broad planning space, having learned the technical issues that wealthy families need to deal with, so that this way I wasn't just a salesperson, which I don't want to denigrate my industry, but many of the professionals in my industry are primarily salespeople, and there's nothing necessarily wrong with that. But I didn't want to be only a salesperson. I wanted to have a much broader scope when I dealt with clients. And one of the things I always admired most about you is what you said. I heard what you said. You may not remember what you said, but you said, I go into these meetings and I just want to help, right? And unfortunately for people, I mean, you're very modest. I know you're one of the more respected people in your space, and always have been, not by me, but broadly in the industry, by estate planning firms and so forth, and deservedly so. But what you didn't ever do is you never were going into a meeting to show how smart you were. And I think that's one of the reasons you're so effective, because so many people who have your set of skills and your background and your visibility in the industry, unfortunately, sometimes also have a big ego, and they let that ego overtake the main purpose of the meeting, which is to help. I want to show that I'm the guy or the woman that knows everything. And I don't want to I'm not looking to generalize, but you've seen that, and I've seen it. And that, I think, is one of the things that makes you so effective and so much of a pleasure for people like me and for your clients, who we share in many cases to work with. So I just think that's important to point out. It's not just about technical skills. I'd say it's about bedside manner. And you have one of the better ones I've seen in the business. So I think the audience should know that.
Maybe I'll go back to how I started out, because I think it might be interesting to the listeners to know how I developed this approach. Like I started work. Sorry,
you're stealing my thunder. So I wanted to ask you that. So now let's do that. Let's go into that. But I think the gentleman's name who was your mentor was Howard Mistoll.
Yeah, correct.
Right.
When I started working at Berdon about 40 years ago, I started out, I was a tax accountant. I enjoyed doing what I was doing. And I was just, working among lots of other people. We had a tax department at that time that had about 50 people in it. And one day, Howard Mistall, who was my mentor, he approached me and he said, "Hey, I got a couple of estate tax returns that I need prepared. You want to do it?" And I said, "Sure." So I took the tax returns, over a period of a couple of weeks. I finished both of them and I went to Howard and I said, "I think these things are in pretty good shape. Who do you want me to give them to review?" And Howard said to me, "Why don't you give them to me? There's no one else in the tax department that knows anything about estates." So a light bulb went off in my head. I said, this guy who's the head of the tax department, who, by the way, was one of the most brilliant tax professionals, accountants or attorneys that I ever had the pleasure of meeting and working with. So I said, if he says there's no one else here but him that knows this stuff, this is a great career path for me. There's no one else here. I really enjoyed this stuff. I started preparing the returns and I saw this would be something that was very interesting. And I learned a lot from him. Technically, he was a genius, but the first meeting that I ever went to with him, I sat down with him and I saw him explain complex theoretical things to a client, very complicated transaction in English. And I said, boy, I have to learn how to do this, because he was very patient and empathetic to the client who had just lost their spouse. And he was very good at explaining things. And he took the technical and he explained it in English. And I learned a lot by watching him. And this guy he was smarter than almost anybody. He never threw that out at a meeting. He handled everything in a very, very appropriate way. And just over the years of working with him, and I had the pleasure of working with him for almost 20 years, I learned a lot, both technically and how to work with clients. And I remember he always told us, what we strive for here is technical excellence and everybody working together to take care of the clients. And I never forgot that, because that's always been my mantra. And it's a funny thing. I noticed that by working that way year after year with a wide variety of clients, that when you work that way, and you were excellent and technically, and you were easy and helpful to work with, I noticed that I was able to bring in a significant amount of business, because I didn't know anything. I modeled myself after what this fellow was doing, and I'm grateful that I had that experience. But other people, like attorneys, like investment advisors like yourself, they would seek me and our firm out because they said, my goodness, most accountants don't do what you do. They prepare tax returns, they give it to us, and that's very limited. They work in a very limited silo. But you do what you're doing, and you think outside of yourself, and you always think about how is what I'm doing impacting the client's holistic plan. And I don't know, it worked so well. It's funny. I was able to generate a lot of work for the firm and bring in a lot of new clients without really ever having to sell, using your words. I never had to go down and say, you know what, now it's time for marketing. The marketing always came to doing excellent work and taking care of the clients. And I learned that throughout my career. I never worried about the money and bringing in business and all of that, because it happened naturally when you did your job the right way. And that's why, circling back to what we talked about at first, I am very surprised that more professionals that work in our space don't think that way. A lot of them just do their job and they don't think about how the other disciplines are going to, fit into the greater good. Life insurance is another great example that you and I always talk about. Insurance people, a lot of them are selling products. And one of the things that I do, just like I sit in on investment advisory meetings to help provide context, same thing with the life insurance. Like, I'll tell a client, I have nothing to gain or lose by this. I'm not selling anything. I'm not getting paid one way or the other. But I made myself become an expert in that area because I wanted to be an independent source of objectivity for clients. Do I need this? Don't I need this? What fits in best with the overall strategic plan that's important to you? And that's
That's right.
basically how I worked through and continue to work throughout my career.
Yeah, and look, well, you mentioned products. I mean, in my industry, as you know, even today, after what I call a large movement from brokers to becoming now registered investment advisories and fiduciary advisors, where they have to, by law, have the client's best interest, we're still an industry that was born out of the desire to create and sell products, right? Financial products. And that's embedded in our culture, and that's a problem. Like you and I work together, and we bring in other team members or work with existing other team members as a group to help the client, not to show the group how smart either of us is, right, or isn't. What that counters is what I see going on in my industry, in your industry, generally in the advice industry, which is there's not a lot of checks and balances anymore. So even though all of the disciplines we'll keep referring to, estate planning, tax and cash flow planning, risk and insurance planning, and retirement planning, all of those integrate and should coordinate together. The 1 and 1 equals 64. But sometimes the problem is people are addressing those issues as advisors because they get paid on them. So if I was the kind of financial firm where I wasn't a true fiduciary in all aspects and I sold insurance, for example, I might know about insurance, but I might be bringing it up because I have the incentive because I know I can make an insurance sale. And so somehow or other, I always find, and I just want your view on this, I always find that it's better to work with independent providers who don't have individual incentives to gain anything other than helping the client, as opposed to where it's all done in one shop and nobody has checks and balances. How do you feel about that issue?
I totally agree. It just makes a lot more sense. It's trickier. It can be very appealing to somebody to say, "Hey, this is great. I can go to one shop and get everything done." But am I really getting objective advice? Am I only getting one firm's perspective or take? One of the reasons that working in my area has been so much fun for me is that you learn a lot. You try to be technically good at what you do, but each client situation is different, and that's what makes it fun. And each client situation, I always call it, it's like a 20-dimensional puzzle. You have to,
Right.
and the first step is that you have to listen to the client. And these client situations are never easy. Sometimes we're dealing with 3 generations of people. We have different clients, and everybody has unique needs. And like you and I always say, when you're putting together a strategic plan, you have to start with the easy building blocks. How much money is coming in? How much money do I need on an after-tax basis to take care of what's important to me? And then is what each of us doing contributing to that? You got clients that you and I work with that, most of them are coming at it from 2 different life perspectives. Either they're just starting out and the planning is, I want to have kids. How do I provide for their education? I want to buy a new home. I'm thinking about retirement planning. Or you got the next level where somebody is trying to reach retirement and their lifestyle is changing. And what do they have to start thinking about? My goodness, I got to start thinking about how am I going to draw money down from my retirement plan in a tax efficient way? What am I going to do when the money stops coming in and I have to figure out a way how I'm going to take what I have and provide for the rest of my life, which in a lot of situations can be 25, 30 years. How do I do that? And that's really the context that each of us, whether we're an investment person or an accountant or an attorney, we should all be thinking about it from that take. And that's what I think is missing. And to your point a second ago, if you're coming out of this from one firm, you're not getting all the perspectives of the thought. I could have different thoughts on things, and then you could come in and you could say to me, that's pretty good, but what if we think about this? And also the beauty of what we do is generally there are not necessarily right or wrong answers. Our job is to brainstorm and present our clients with different suggestions on how to do things and let them make the decisions. That's when we met like 27 years ago. That's one of the things that I picked up on right away, why I enjoyed meeting with you, and you and I have become good friends. We approach these things from the same angle. We're not afraid to brainstorm and come up with different suggestions. And it doesn't matter whose solution is the one we end up with. Our total focus is taking care of the client. And it's also interesting, a lot of people sell stuff, whatever discipline they're in. I find that we make more than enough money just by doing things the right way, because clients appreciate that and they want to work with us. I'm convinced.
I would change what you said. I would take out the then enough. I bet you in the long run, then most of the people we're providing services alongside of would probably make more money. Why? Because if you're doing the right thing, your clients are staying longer. They're referring their friends, and that compounds to me and makes up for whatever the sales that you might miss by selling some stuff. That's just how I always viewed it.
No, I totally agree. I don't know. It's worked for me for a long time, and that's why, I enjoy working with you. One client that you and I are working on currently is a perfect example. There was a matriarch of a real estate family, and it goes back. I got involved with them about 25 years ago when the patriarch had just passed away. And we worked together with the estate planning attorney. And over time, we collaborated and did a lot of different things. And in this situation, we had a grandparent, parent, grandchildren, now great grandchildren. And it's tricky to plan because everybody had different needs and different goals. We worked over the years, including with our business valuation group, to figure out intelligent ways to transfer the real estate business down generations into tax efficient trusts that are not even going to be included in the kids' estates. And we did it by isolating the business assets that made the most sense to transfer. Like I said before, which are the ones that are cash flow producing, which are the ones that are projected to increase in value. And over time, through working with an excellent estate planning attorney, we transferred a lot of assets and a lot of growth and significantly reduced the estate taxes. We also brought in life insurance where it could strategically help. And then you and I met with the principals over time and figured strategically how to invest their assets with the overlay of the real estate business. And, that could be a typical scenario, but also very different. And the matriarch just passed away about a year ago. And now we're working from a different perspective, transitioning the business interests to the children and grandchildren. And, like you always say, this is a major life event change where we have to sit down with the beneficiaries and figure out, okay, now what does it mean? If somebody wants to retire, what are they looking for here in cash flow? What can they expect? And when you and I work together, and the attorney in our situation too, what makes it terrific is we're all working from the same perspective. We're looking at what we're primarily responsible for, but we're making sure that we're always thinking about, am I taking care of the client? Is each of these clients' holistic plan being taken care of? And, these things evolve over time. Like when the matriarch passed away, you can't just have a static plan. Things are going to change. And when they change, that's when you have to jump in and, and act and, rejigger the plan when the paradigm changes.
Yeah, when things change, like even on a sub level, like for example, when the grandchild recently got married and had a baby, right? That changes what the plan might have looked like if it was 3 years earlier that the matriarch passed away, right? So there's all of these things. And what I love about the way we work together is I call you, you call me, and we say, why don't we hop on the phone today? The meeting's in 2 days. These are my thoughts. What are your thoughts? And even together to then let's challenge those thoughts and see if there's something either of us might be wanting to add or might have overlooked. The other thing thing I want to ask you as it relates to going back just briefly to Howard Mistall, because I know how wonderful you say he was. And I know you also said in the beginning of your career, you chased him around kind of like a little puppy dog and he shooed you away once in a while, like I shoo my puppy dog who's begging for food. But you kept going back, which is great because you knew that there was so much wisdom there to have imparted on you. But there's got to be at least one, if not more than one, aspect of what Howard did, and I didn't know Howard too well, that you were able to enhance, right? That you were able to say, this guy was great. I got all this knowledge, and this is how he does this, this, and this. I think if I did it this way, could even enhance it. I'd love you to share that if you could think of that.
Yeah, Howard was terrific, like I said, but what I wanted to make sure we were doing is expanding how we looked at it. You know, the chart you were referring to that had all the different spokes on it and the different aspects of financial planning. That chart was something that evolved out of me that I thought about because Howard was terrific with the clients, but he was still a bit compartmentalized. Howard was a bit, I don't know what the right word is, if it's shy or whatever, but like, you know, he would make a call to the estate planning attorney and say, hey, you know what? This business asset is throwing off cash flow, but this is the one that's going to grow. Let's look at gifting it. He would do that, but it was a little bit more limited. Howard never sat in on the investment advisory meetings. He didn't want to intrude on the space. He didn't really go over the life insurance planning. You know, he let them do it in their own way. So you really enhanced it by really emphasizing the importance and developing it the way you wanted to of the holistic, integrated approach. I mean, to everything, right? Making sure that was really what led the group's planning efforts. Yeah, absolutely. Because I'm telling you, when I work with a lot of different people in different areas, I am shocked at how few people in different disciplines really think that way. Definitely in my profession, people are afraid, oh, I don't do life insurance. I don't know that. I don't know anything about investments. So I wanted to develop that expertise so I could help better. I felt like I could really help better. And that's why, you know, when people look at the chart, they'll see that, and you know, it's interesting. Nobody really, it doesn't matter. The leader sometimes in each of these situations is a different person, but it doesn't really matter. If everybody checks their egos, like you said a little while ago, and they really focus on helping the clients, this stuff really takes care of itself. You know what else I'm surprised about that you and I talk about? I am shocked how many clients worth a lot of money, even north of $100 million, are just not getting taken care of the right way because they don't have advisors that really come at it this way. I guess it shouldn't surprise me, but I've been put in front of a lot of situations where these clients they don't have really integrated strategic plans. They just don't. Well, what's interesting is the last podcast guest I had, I don't know if you had a chance to listen to it, but Cheryl Penny, who created Dynasty Financial Partners. So he was basically saying, to shorten up what relates to what you were just talking about, is that the big family offices, right? These people who have hundreds of millions of dollars, they can afford to decide, I don't want to work with Fidelity as my custodian. I'm going to work with Schwab or Pershing. They have enough money to do that, right? But the average investor can't decide that, right? The average investor doesn't have the clout to choose their own custodian in that regard, right? They have to work with whoever their firm is working with. But what Cheryl Penny recognizes, having worked in that high net worth area at Citigroup for many years before he founded Dynasty, was, well, imagine if I can aggregate firms like Jonathan that could get to, billions of dollars, right, in assets, hundreds of billions of dollars in assets. Now we have that power. Now every smaller client has the ability to operate as if they were family office. Jonathan can choose whether he wants Pershing or Fidelity for the clients, and they can choose to have their advice coming from a place where there aren't products being sold. We can go to Blackstone or Goldman Sachs or wherever you want to go, Vanguard. And so that democratized that whole scale that was only available to the very wealthy. But you're saying something, that's why I want to relate to it, that even the very wealthy like that oftentimes are not getting the right planning advice from whether it's me or whether it's you or whomever it is. Well, you know what I see? I've always said that the strategic planning and what people need to think about, it doesn't matter if you're worth $1 million or $100 million. You have the same issues. It's just a matter of zeros. How much money
Right.
is coming in? How much money is going out? And what are my goals? And what's my overall strategic plan? It's the same difference. So whether you and I are planning for someone of more modest means, or we're talking about somebody who's worth $500 million, doesn't really matter. It's the same types of things. And if you
Well,
just,
I actually say it matters even more, because what you're saying now, I'm going to steal a little bit of the topic and go bring it a little bit back to behavior, since that's important to what we're doing on the Crazy Wealthy podcast, but also in how you and I practice together. You, through what I've done over the last 5-6 years, you've really embraced it, which I'm so happy and proud of. But when I wrote the article in the middle of 2020 that Barron's published, highlighting the behavioral approach that was taken by the world's, or at least our country's, wealthy investors, known as the Tiger 21 group, and Tiger 21, led by this fellow, Michael Sonnenfeld, very successful, smart entrepreneur. But what I learned by looking at their quarterly publication of what, as a group now, they manage over $100 billion of their own money, what they do with their money, more cash this quarter, more hedge funds next quarter, they was disclosing that as a group. And what I found is what I already instinctively knew, but could prove through their own published data, which is that these people, as wealthy, as smart as they are, make the same mistakes as the people who are less wealthy and less successful in business. But they did it with two big differences. And this goes to the point you were making. They do it with a lot more money and a lot more confidence. And so the benefit, right, of the good advice to them, I would argue, is more valuable than to the smaller clients, because the dollars that you're saving and helping them manage properly are much more impactful, right? So but sometimes, because they have big egos, justifiably, I get it, they don't think that it applies to them, meaning behavioral foibles doesn't apply to them, right? They're not human, in other words, in their mind, is really what they're thinking. I'm going to bring that back for a second, Scott, and it's a little bit selfish, but I've always been proud because I know how good you are at what you do, and our friendship developed the way it did. But I guess sometime close to 20 years ago, you called me and said, I'd like to talk to you about advising me on my investment planning. Tell me a little bit about, without, you don't have to shower me with praises, but I just want to, that to me is so meaningful. And because you have such a perspective that I respect, whether you were my client or someone else's. If you told me, I think you should use this estate plan, I would respect that, just because I trust your judgment that way. So I'd love to hear what led to that. And then I'll ask you a separate question on that.
well, my wife, Nancy, and I were getting to a certain point where I was thinking about scaling back working. Like over the past 5 years, I sort of transitioned, and I'm working a lot less hours than I used to, more part-time. So the money coming in is less. And I started thinking about, what do I want to do here if I stopped working? And I just thought it would be good. I felt comfortable. I was handling things myself, but I thought it was important to partner with somebody who could help me with that. And since your and my philosophy was so aligned, I thought that you would be perfect to partner up with. And also, I was also concerned, what happens if, God forbid, I passed away and Nancy was by herself? Like, I have a good handle on this stuff, but she doesn't. She doesn't have the same kind of interest in it that I do, but she would need help. And I was thinking, who would I want her to call if something happened to me? So based on just helping us today, like you've been doing, but even more importantly, what would happen if I passed away and Nancy needed help? I thought, who better, could I put in place for her to call, to help her with planning for the rest of her life?
Well, your trust in me for that has always meant the world to me. And but I want to take a step. This again is what I said early on about you being so good at what you do, not just because you're technical, because of your selflessness, because you're not going in to show how smart you are. One of the things I tell people who come to interview us when they don't bring their spouse and they say, my spouse, she doesn't need to do anything with this. I don't need to, whoever the moneyed spouse is, they don't need to come in. And I always say to them, I won't work with you because You might not be meaning to be. So let's talk it through, because if you are, I won't work with you, period. If you're selfish and you're meaning to be, I don't work with selfish people. But if you're selfish, you're not meaning to be, let me talk to you about why I'm telling you that. Because even if you think you're the smartest person in the world, you made all the money, you can make all these decisions, even with my help. Your wife doesn't need to come in. If you're the spouse with money, that's the wife. Your husband doesn't need to come in. It's selfish, because what happens is you may or may not know all those things. And behaviorally, you're just as susceptible as everyone else, which you might not accept, whoever you are. But you may or may not know all those things, but your spouse doesn't. And if you're going to keep them in the dark, and the first time I meet them is the day, God forbid, something happens to you, shame on you. And so that goes back to another where you're selfless, right? You said I could do some of this, but I wanted to have someone help me. And I also wanted someone for the continuity if, God forbid, something happens for my family. And that's just so important. It's such an important to me reason why people should hire people in this space that they can trust and that they do trust. So, one of the things I want to also now relate back to behavior. Recently, you've gone to a couple of meetings, big wealthy family time meetings where they're reviewing their investment plan and so forth. And it always seems to start because of the behavioral work we've done together. And you've read all my information and podcasts and so forth. So you've learned some things from it. And what I love is you go to these meetings and it immediately almost starts with the same thing. Well, this investment performed XYZ versus the S&P that did this. And they go into a dissertation for about 40 minutes, and you take them back and say, wait a minute, guys, this is all okay, but let's talk about what your objectives were as we sit here today, a year ago, and let's see how far or close we are from having met them. And should we make any changes to the plan, right? I mean, you took it back to the basic. And what I always find is that when you talk about planning, what I always say about planning is someone will say, so you always talk about planning. Someone once said this to me, Jonathan. So you're telling me if I have a plan, I'm guaranteed to make it. I never said that. Here's how I like to frame it. Having a plan is no guarantee of success. The failure to develop a plan is the closest thing I've ever seen to a guarantee of failure. That's how I put it to them, right? And when that's what I always say. And so when you go into these meetings, they forget all about a plan. It suddenly gets focused on all the wrong things, and they start performance chasing and miss the whole point. And the expertise of the people like you in the room gets squandered potentially. But you don't let that happen. So you can talk about that.
Well, that's why I said, like before, that's why I like to sit in on the meetings, because you can always bring it back to the overall strategic plan. One thing I did want to mention before we wrap up is sometimes there are external factors, not often, but sometimes there are that could impact the plan. And one of them is that the 2017 Tax Act is set to expire at the end of this year. And one of the big things, and you're in my space, is the current lifetime estate and gift exemption is currently pegged at around 14 million a person, or 28 million for a married couple. If the tax law expires and it goes back to the law before the Tax Act was set in, the exemption will be halved. So you'll be at about 7 million or 14 million per married couple. That gives us a real opportunity to think about this. In all likelihood, the Tax Act will get extended. I know in the House bill that's currently out there, they're talking about raising the exemption to 15 million, still with increases to inflation over time like we have now. But what if it doesn't? So one of the things we should be telling our clients is, let's take a look at this. Let's make sure we use the exemption up before it potentially expires, or at least look at opportunities and tee up some planning so that in case we see that the tax law is not going to get extended, we can act. You don't want to be sitting there and calling your estate planning attorney in November, like thousands and thousands of people might do. And then who knows if you'll get to put together a plan and not waste the exemption. So that's that's why it's important to be on top of everything. And that's important to alert your clients. Just an example, because sometimes there are external factors that impact what's going to happen.
No, it's true. That's a good point to bring out. By the way, I just one of the things that relates to you, because you exemplify what I think every investor should embrace as an objective to be able to reach their goal. What I mean by that is almost every investor I ever meet, their objective is, let me see if I can outperform some random benchmark, some managers, or whatever it is, and it never can consistently be done. And they fail to meet the real objective, which is whatever their goals are. When you and I first sat down to work together, I'm not going to say what your goal was numerically, but you gave me a goal. You said, Jonathan, this is what I'd like by this amount of time, and this is why I know I never have to worry, and that's my number. I used to have the commercial, what's my number? And I'm proud to say, because of your steadfastness in focusing on what's always important, you didn't meet the goal. You're more than twice the goal, and you're still building. So that's just something that everyone would get there if they could have your temperament and your ability to look at it the right way. I don't know, how to get people there other than what we already do. Teach them that, a goal is not beating the S&P. A goal is not beating my friend's broker who bought Bitcoin for you. A goal is, I'd like to retire by X age. What's the principal sum I need to get there to be able to retire comfortably, stay that way, and leave some legacy? But those are goals. I'd like to buy my kid a first home. Those are goals because they're achievable. They're achievable, right? I could say you have to work a little more, you have to spend a little more, I can get you there. Or I could tell you, we have to change something and you can't actually get to that goal, but let's look at this goal. I want to finish by saying how I define financial planning. This is just for the audience in 20 words or less. This is something I was taught by my mentor, Nick Murray. It's the ability to protect against what might go wrong in order to have the luxury of investing for what can go right. And and the reason that's so important is, if we don't protect, to your point, insurance, whether it's home insurance, property and casualty, life, whatever it is, then all this other stuff is a waste of time, because I invested and now I've got to use it because I have to self-insure, pay for it myself because I never planned for something that could go wrong. And so it's so important just to leave that thought with the audience, that planning encompasses all of that. And then whatever you'd like to add at the end, Scott, please.
No, that's fine. But like what you said, that's why this area is so much fun for me. And it's so challenging for guys like you and me, because if our focus is on helping people and helping as many people as possible develop really, really good overall strategic, holistic plans, I think that's great. And, obviously it's important to get compensated for all of this. But I think if you do, like we said, excellent work, collaborate together, all the advisors, to try to help clients meet their goals, and we really listen to them and help them, that's great. That's why I want to continue to work and do what I'm doing, because it's fun and there are unlimited challenges out there. I told you, like before, I see that. I meet with people that are worth a lot of money that really don't have these plans. And if one by one, guys like you and I can make a difference and help people, I think that's great. And it's worthwhile to do.
Well, thank you, Scott. I'll say that in my industry, I've noticed maybe sooner, but in the last roughly 10 or 15 years, I've noticed a lot of firms in the industry throw out the term goal-based planning, right, to try and market themselves that way. And I could just say that you were, in my view, a pioneer of goal-based planning, probably 35, 40 years ago, and you practice it better than almost anyone I've seen. And it's a pleasure to work with you. And I love calling you my friend. And thank you so much again for being here today on the podcast.
Oh, you're very welcome, Jonathan. And I thank you for having me.
Stay tuned to hear Amy's call-in for the recap of today's episode.
Hey, honey, happy June.
Happy June to you.
It's so nice out, finally.
I know. I feel like we just escaped winter today.
I know. That's really how it is. It's kind of hard to stay in the office on such a gorgeous day today. Did you do anything exciting?
No, I had a bunch of work to do. Got it all done. But the best thing I did was had the interview with Scott Ditman, my friend and former head of the Personal Wealth Service Tax Department at Berdon LLP, which is now part of Citrin Cooperman. He was also a member of the executive committee. And he's become a great friend. We met when I was 31 and he was about 40. And today he's approaching 70 and I'm approaching 60. So time goes fast.
It's amazing, because I remember at the time when he was someone that was referred to you, you thought that was the biggest deal because he has such a great reputation in the industry.
Yep, and his reputation in the industry, um, I guess, among some people who hold him in high esteem, is because of his knowledge and his reputation as a planner. But I see a lot of other reasons, at least why I hold him in such high esteem as a professional that I've always enjoyed working with.
Why?
Well, because Scott is respected as one of the top people in his field. But he never, in my experience, when we work in a team with the client's estate planning lawyer, corporate lawyer, risk management, insurance planner, and you go into a room as a team, so many people with Scott's credentials and reputation often, I guess it's human nature, go in the meeting and lose focus on how we can work synergistically to help the client, and instead focus on trying to show how smart they are relative to the other professionals in the room, right? Especially in front of the client. And that's never been Scott. Scott always puts all that aside, doesn't even come into play. And he's always just looking to do better for the client as the primary focus. And I've always had so much respect for him in that regard.
You know, it's funny. One thing I always wonder is why does one decide like that I'm going to become a great tax guy? What leads someone down that path?
Well, I guess when you try male entertainment and you find you can't make a living,
I know, I know.
I'm not suggesting if Scott's listening that he tried that. So don't take that out of context. No, look, I think like Scott said, he just was very interested from the very beginning in the trust and estates area. There was a partner at Berdon when he started as a young professional, Howard Mistall, who he reveres. He says, what a great professional in terms of his intelligence and command of the area. And Scott told me how he used to follow Howard around like a puppy dog, even like when you'd swat your puppy dog, like go away. Scott would just come back and want more work, and until he finally figured, I could learn this guy. I have to be like a sponge, and just anytime I can be around him, I want to be around him. And that's Scott, and he really, and I asked him during the podcast, as good as he was as a mentor to you, I'm sure that you must have taken something that you got as a page from his book and maybe enhanced it. So we talked about that. And the way he enhanced it, he said, is, Howard was a little shy, so he might call the estate lawyer and go over some things with the estate lawyer relative to the team that's working on behalf of the client independently. But Scott took it to another level. He would want the team to come together. And 1 and 1 equals 64, right? We all have to put our heads together and challenge and come up with different perspectives and all of that kind of thing. So he kind of, I think, invented goal-based planning. My industry talks about that all the time. Like, you shouldn't plan based on performance or based on certain metrics, only goal-based. But I think Scott kind of originated the whole idea of goal-based planning as it relates to doing it with a team on behalf of the client independently.
That makes sense. And I know you try and do that whenever you can. Now
That's why
that
Scott and I work so well together. It's one of the things we talked about.
now that you're saying how he got into the business, as your marketing guru, or I think I'm your marketing guru. I'm not really a marketing guru. I feel like one of the next things you should be talking about on one of your podcasts is the importance of mentoring and how important it is to have a mentor. So how important it is to be a mentor. And I know you've mentored some people along the way, and you've also had some great mentors along the way. So, that might be something to think about for the future.
No, that's a good idea. In fact, we touched on it 2 podcasts ago with Mindy Diamond, when I said, what do you recommend for young entrants into the wealth management? She said they need to find a mentor who really cares about them, really is willing to take them under their wing. And I explained to her how actually right now we are at Fusion engaging in that exercise.
Yeah, I think one of the most important things when you start in any industry is to find someone you really respect and take great things from them. So Scott not only did a great job for this podcast, it seems, but he's going to help us in future podcasts.
He'll help us in future podcasts. And one of the most touching things from the podcast is I asked Scott, because in over the years, whenever I needed a reference for an attorney or insurance or anybody, I would go to Scott because I know how thoroughly he vets them, not just for their expertise, but for their demeanor and their character. And I said, so with all of that, you must have come across a lot of wealth managers. And he said, well, just I'm curious. Don't pat me on the back, but what is it that led you to choose me as your advisor personally? And it was very touching because he said, look, I know a lot of this stuff. He said, it's not just that I wanted help. I wanted someone, if God forbid something happens to me, that I would be able to trust for Nancy to be able to continue with someone I trust. And I thought, who better than you? And that I couldn't have asked for a better compliment.
I'm going to end this because you're always fishing for compliments, and you want me to say right now, honey, that's true. You are the best.
I never said I'm the best.
One of the best, right?
Among, maybe.
Among. Okay. Everyone,
You're the best.
I'm
Baby,
the
you're the
best.
greatest.
Okay. I'm not fishing for compliments like you, bud. Well, I'm
All right,
glad you had
honey.
a great conversation today. I hope you enjoy the rest of the great weather.
You too. Love you. Bye.
Love you.
Thank you for tuning in to another episode of the Crazy Wealthy Podcast. For more insights, resources, and to sign up for our newsletter, visit crazywealthypodcast.com. Until then, stay crazy wealthy.
The previous podcast by Fusion Family Wealth, LLC, Fusion, was intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy or any non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation. Neither Fusion's investment advisor registration status nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Fusion is engaged or continues to be engaged to provide investment advisory services. Fusion is neither a law firm nor accounting firm, and no portion of its services should be construed as legal or accounting advice. No portion of the video content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Fusion is engaged or continues to be engaged to provide investment advisory services. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.